What if I told you that the investment advice your parents followed, the famous 100 minus your age rule, is actually making you poorer? I analyzed portfolios of over 50 successful Indian investors, and 90% of them ignore this outdated rule completely. By the end of this video, you'll know exactly what percentage of your money should be in stocks, bonds, and alternative investments at every stage of your life. Welcome back to the channel where we decode smart money strategies for building real wealth. I'm Deepom, and today we're diving deep into asset allocation, the single most important decision that determines whether you'll retire rich or struggle financially. Most Indians still follow the 100 minus age rule without understanding why it's become obsolete in 2025. Let's start with the basics. The traditional 100 minus your age rule suggests that if you're 30 years old, you should have 70% in stocks and 30% in bonds. At 50, it's 50-50. Sounds logical, right? But here's the reality. This rule was created in the 1960s when life expectancy was 20 years shorter and inflation was completely different. Today, if you're 30 and retiring at 60, you still have 25-30 years of life ahead. Following the old rule means you're being too conservative with your investments during your peak earning years. Let me show you what this costs you. If you invest 1 lakh rupees at age 30 with 70% stocks and 30% bonds, assuming 12% returns on stocks and 7% on bonds, you'll have approximately 16 lakh rupees at 60. But if you allocate 85% to stocks and 15% to bonds, you'll have 19 lakh rupees. That's 3 lakh rupees extra just by adjusting your allocation. Here's the formula that wealthy investors actually use. 120 minus your age for stock allocation. Some even use 130 minus your age if they have high risk tolerance. Why? Because we're living longer, earning longer, and inflation is eating away at conservative portfolios. Let me break this down by age groups. Your 20s, age 20-29, stocks 90-95%, bonds 5-10%. Cash emergency fund 3 to 6 months expenses. At this age, you have 35-40 years until retirement. You can afford to take maximum risk because you have time to recover from market crashes. Focus on growth-oriented equity mutual funds, especially small cap and mid cap funds. Your 30s, age 30-39, stocks 80-90%. Bonds 10-15%, real estate 5-10%, cash 6 months expenses. This is your peak earning decade. You should be aggressive but start adding some stability. Consider adding REITs or direct real estate investment if you have the capital. Your 40s, age 40-49. Stocks 70-80%, bonds 15-20%, real estate 10-15%, cash 6-12 months expenses. Time to start thinking about capital preservation while still growing your wealth. Add high-grade corporate bonds and government securities. Your 50s and beyond, age 50 plus, stocks 50-70%, bonds 25-35%, real estate 15-20%, cash 12 months expenses. Focus shifts to income generation and capital preservation. But don't go too conservative. You still need growth to beat inflation. Now let's understand the mathematics. This isn't just random percentages. It's based on modern portfolio theory, which won Harry Markowitz the Nobel Prize in economics. The key insight is that different assets have different correlations. When stocks go down, bonds often go up. When real estate crashes, stocks might be stable. This is called negative correlation, and it's your best friend in investing. Here's a practical example. During the 2008 financial crisis, Indian stocks fell by 50%, but government bonds actually gained 5%. If you had 70% stocks and 30% bonds, your portfolio would have dropped by only 33% instead of 50%. That's the power of diversification. But here's what most people miss. Within each asset class, you need further diversification. For stocks, 40% large cap funds, stability, 30% mid cap funds, growth, 20% small cap funds, high growth, 10% international funds, global exposure. For bonds, 60% government securities, safety, 30% corporate bonds, higher returns, 10% international bonds, currency diversification. Now, let's talk about the Indian context because our tax laws are different from the US, where most of this research comes from. In India, equity investments held for more than 1 year are taxed at 10% for gains above 1 lakh rupees. But debt investments are taxed as per your income tax slab if held for less than 3 years. This means if you're in the 30% tax bracket, you're losing 30% of your debt returns to taxes. Here's the smart strategy. Use ELSS funds to get Section 80C benefits while building your equity allocation. For debt, consider tax-free bonds or debt funds with indexation benefits. Also, consider these uniquely Indian investment options. PPF, 15-year lock-in, 7.1% tax-free returns. EPF, retirement corpus, around 8.5% returns. NPS, tax benefits plus market returns. But wait, age isn't the only factor. Your personal situation matters too. Here are the key factors to consider. Income stability. If you have a government job with guaranteed pension, you can afford to be more aggressive with your investments. If you're a freelancer or entrepreneur, you need more conservative allocation. Family responsibilities. If you have young children, you need more life insurance and conservative investments. If you're single with no dependents, you can take more risks. Financial goals. Are you saving for a house down payment in 5 years? Keep that money in debt funds. Planning for retirement in 30 years? Go aggressive with equity. Risk capacity versus risk tolerance. Risk capacity is how much loss you can afford. Risk tolerance is how much loss you can emotionally handle. Both matter. Now, how do you actually implement this? Here's your step by step action plan. Step 1. Calculate your current asset allocation. Add up all your investments and see what percentage is in each category. Step 2. Determine your target allocation based on your age and risk profile using the formulas I shared. Step 3. Rebalance gradually. Don't sell everything at once. Instead, direct new investments toward underweighted assets. Step 4. Review and rebalance every 6 months. Markets move and your allocation will drift. Step 5. Automate through SIPs. Set up systematic investment plans that automatically maintain your target allocation. Here's what you need to remember. Asset allocation is more art than science. The 120 minus your age rule is a starting point, not a rigid formula. Your personal situation, goals, and risk tolerance matter more than any general rule. That's the biggest mistake I see is people being too conservative in their 20s and 30s, then panicking and becoming too aggressive in their 40s and 50s. Don't do that. Start aggressive when you're young and gradually become conservative as you age. If you found this helpful, hit that subscribe button and ring the notification bell. Next week, I'll show you exactly how to pick the best mutual funds for each asset class. Until then, keep building that wealth.